it's actually going to be an extension of that conversation we just had. But, so this Friday we have our retreat, and a big portion of that is going to be talking about the financial side of things. And so wanted to kind of run through the components of the income statement and the balance sheet, because then that's going to make it more understandable this Friday when we're actually running through real numbers. So what are the two things that we've talked about as far as financial statements? What are the two?
You're talking about your assets and your...
No, so what are the two main financial statements that people look at?
Balance sheet.
So you've got your balance sheet. And what? Your profit and loss statement. Now, a lot of times you hear this called P&L. So if you ever hear that, that's what those things are. So you've got components that make up the profit and loss, the P&L, and the balance sheet. And so on the top line of P&L is what? The first thing that starts everything off.
Income.
Revenue, right? Income. What's revenue? There's a difference between revenue and income, and that's where we'll get to. So revenue is is what you bring in. And so in accounting, there's also two things that you'll hear. There's cash basis accounting and accrual basis accounting. I think that's how you spell it.
Yeah.
So what these are, what cash basis is essentially, when we're doing our numbers, is revenue. What accrual is invoiced. So that would be this from this number. So don't get confused when we cross over. So what cash is actually what has been collected or what has been paid. So this counts for both incomes and expenses. So on a cash basis, revenue is what have we physically collected from our clients and deposited into our bank account. For expenses, cash basis is what have we physically either charged with our credit card or written a check for. Accrual is what have we invoiced or what have we been billed. Does that make sense between the difference between those two? So when you hear cash basis, accrual basis, that's what that is. So for the sake of today's discussion, we'll focus on cash basis, because that's what our tax returns are based on. So it's what we actually collect and what we actually pay. So revenue is how much we have actually invoiced and collected. And then the next thing that comes out of there are what are called cost of goods sold. Who knows what cost of goods sold is? It's pretty explanatory in its name, right? So what are some examples of our cost of goods sold?
Labor.
What's that?
Labor.
No.
Employees.
Only labor if we have to outsource, right?
Correct.
Supporting material we have to buy,
Like what?
like templates or
Hosting?
plugins.
Right. Okay.
Hosting, plugins.
Hosting, like our expenses of hosting, our SEO when we pay traffic flow SEO. That's a cost of goods sold.
Needed.
Most easily is in promotional products and apparel,
Okay.
print and collateral. The cost of those. So if we invoice $100 for a apparel order, and the cost of the goods sold are $50, then that makes our gross income is the difference. So if, in that instance, if it's $125 that we collect for an order, and then to get the shirts made and printed cost us $50, then that means our gross income on that product would be $75. Does that make sense? So out of that then comes all of our expenses. So you've got what's the biggest one? Payroll, right? You got payroll, you've got rent, you've got all the stuff that makes the business run, so like the internet, the computers, so equipment,
Pull-up bars.
pull-up bars, professional services, so legal, accounting, all of that stuff. And once you start subtracting all of this stuff out, then you get to what's called net income. Then out of net income, well, I guess technically this is pre-tax net income.
EBIT.
So that's called earnings before interest,
Taxes.
taxes, depreciation, and amortization. So that's technically called EBITDA.
Did you say that, Steve?
You guys ever heard people talking about financials and they say EBITDA? You're like, what in the hell is that? So what that is, so that's earnings before interest, tax, depreciation, and amortization. And so these four things, interest, so when you start paying out all this stuff, so then you start subtracting out for EBITDA is the interest that you're paying on long-term debt, because that's not technically, because these are operating expenses. So these are your operating expenses, and then you have kind of fixed expenses that you're paying off your long-term debt. And so long-term debt, the interest is deductible, but the principal that you pay down is not, because that's already came on up here as an operating expense. Taxes that you pay, so we'll go over that. Depreciation. So when we buy a computer, or we buy major equipment, that we don't get to just write off the $2,000 for the laptop. It's what's called depreciation, and it's amortized over, I think computers are probably 4 years.
3 years.
Is it 3 years? So we get to deduct, so if it's a $2,100 laptop, we get to deduct $700 a year for the next 3 years. So that means technically that comes out of cash, but we don't get even deduct it until after the fact. And then amortization is kind of the same kind of the concept with that. So, like we talked about before, the biggest one that comes out of there, because we don't have a lot of fixed assets. So if you think about a manufacturing company, they have huge machines, they have huge trucks, they have all these things that they have to depreciate. For us, it's mostly equipment it's kind of low-cost equipment in the grand scheme of things, computers and cameras and monitors and stuff like that. But the one thing that does come out are taxes. And so this is where, not to get completely political, but just so you understand the discussion that's going on in like the presidential debates. When Romney's talking about lowering interest rates to increase jobs, here's where this comes into play, is right now the earnings right here then get to go through getting taxed. And so in general, you can count on that being about a third. It's a little bit, some years it's a little higher, some years a little lower, because based on the other components, because it's dependent on where you're at in the tax bracket. So just consider it about a third. So when you take out taxes that are a third, then at that point you get to net income. That hopefully is green and not red. And so when the discussion is lowering this rate on businesses to encourage job growth, as you'll see where that comes in, is what makes net income go up is all of these numbers being down, and then you can apply those things. So if this number is 15%, say it's cut in half, then that's 15% of this number that goes back into operating cash. And so if you have 15% higher operating cash, you're more likely to be able to afford to bring on someone else. So what I want to kind of focus on now is how each one of us can affect this net income number. So what are the two biggest variables on this whole list to get down to net income? Because it's pluses and minuses, right? So what's the biggest, well, what is the only plus? Revenue, right? So everything comes out of there. And then what's the, then you've got operating expenses that are the biggest negative, of which the biggest one is payroll. So in our industry, in a service, and specifically in a service-based business, the goal is to get this number to be about 45% of gross income. That's about what that's the kind of industry standard. So if payroll is 45% of gross income, that's a pretty big number, right? So there's 55% of everything else is still down here, which hopefully includes some net income as well. So typical goals for net income are between 15 and 20%. So at that point, that's now 60 to 65%. So only 35 to 40% is in everything else. So if we've got revenue and we've got payroll, our two biggest variables, how can we impact this number as individuals and as a team?
Be more productive.
Right. Because a lot of times what people will often say, well, cut payroll. But that's not really the answer, because then that also could impact revenue. So it's kind of a supply and demand kind of curve. So it's about maximizing what?
B&E.
The two F words, right? Effectiveness and efficiency. So it's like F squared. So when you can maximize your effectiveness and efficiency, then what you're doing is for every dollar of payroll, you can increase the number of productivity from a revenue perspective, right?
Mm-hmm.
And so that's why we focus so much on effectiveness and efficiency, because that's how we maximize this equation. So how can we make payroll at dollar X be bigger than, or be less than a revenue dollar? So we want to continually figure out ways to maximize this equation. Is how do we make that payroll dollar stretch farther into a revenue dollar? And that's where we focus every day on trying to make us better, is because that's how it filters down into net income. This is why we track all of our KPIs, because those are the things that make a big difference. Because what ends up happening, with design and development, when things come back through, then that means you're spending payroll dollars on less efficient use of revenue dollars. And so that brings down the ratio. What happens when account managers, you have to spin your wheels to try to get a hold of somebody to get a meeting scheduled? Think about that dollar. Think about the counter that's going on your time. That's lowering the efficiency and effectiveness of the time that goes into the revenue dollar that is being acquired. The easiest way to think about it is if we were a manufacturing company, payroll, this 45% gets replaced with equipment and machinery, right? Because that's their biggest assets then at that point. So think of yourselves as productivity machines. And if you're running at low efficiency, then it's like a machine that's kind of wobbling and spitting out things that aren't right. And so if you got a machine that are producing things that are messed up, you got to pull them off the line. You got either throw them away or redo them, and those are all things that make that efficiency ratio go down. And so that's where we really want to continue to focus on building up those efficiencies, that effectiveness, and focusing on knowing that every hour that you're spending is a dollar that goes either towards or pulls away from the revenue efficiency. Does that make sense?
Mm-hmm.
So what I was trying to work on, Ben saw me earlier, I was trying to work on like a geometry lesson to kind of show kind of how this works. And I couldn't get the full out ratio going, but so we've talked in the past about kind of pyramid growth, right? And there's you guys have heard the Pythagorean theorem, and so that's a squared, b squared, c squared. So what the Pythagorean theorem says is that the height of the hypotenuse is a squared plus b squared equals c squared. And so the hypotenuse is, if this is a right angle, it's this. It's the one that's across from that. And so where it kind of ties back in is when we talk about the pyramid growth, is the more we can learn, the more we can get better, the wider our base gets, right? And as the wider our base gets, then the higher the triangle can go. And so really what this focuses on is if we can focus on building c squared, which is what we can control, with effectiveness and efficiency, then your revenue and your expenses, the revenue and therefore net income will then continue to rise. Because technically we can't fully control. This is kind of sales department controls what comes in at the top, right? But our inhibitors to growth, what prevents us to be able to grow, is how fast and how effective and how efficient we can get things out. And that really comes from us continuing to build this base, which is going to allow us to grow that business revenue, that revenue number, that top line, even higher because we can get it out, in a direct proportion to your guys' ability to get it out effectively and efficiently. So I just dropped some Pythagorean theorem. Does that make sense though?
Mm-hmm.
Yeah.
Because this is what you guys can control. This is what sales controls. But this area here, which is essentially our net income, is in direct proportion to how good you guys are at your jobs, and how well you treat customers, and how easy it is for them to come back and do more business with us.
I would say actually, while yes, sales does control a lot of the revenue, since our business is 100% referral, I think that you guys control a lot of that
That's a good
number as
point.
well.
Yep.
Because our business is all referrals, so the more happy clients we have, the easier it is to drive that revenue number up and up and up. So Cherie Berry already has referred over potentially $23,000 worth of business off the first one because she's happy, they love it. So you guys do control that revenue number. I think good.
Yeah, that's a great point. Which is why our company-wide KPI is: would you refer us to friends and family, and would you use this again for future needs? That's where those come into play. So that's a really good point. So that is how you contribute to. So maybe it's a squared is straight up sales, b squared is the customer satisfaction, and then c squared is actually f squared. See what I did there?
Yeah, it's cool.
Questions? Comments?
Is there an ideal ratio between the payroll dollar and the revenue dollar that you're looking for?
There is something that's called the effective billable rate. And so effective billable rate is really the your payroll divided by your gross income, which at this point is 45%. So transposed, that's really after all things, after gross income, after everything comes out, is about 45. So that 45% is what we talked about in the value gap stuff, where we want to have the actual billable rates goal to be above 100, because then that's where it all starts kind of filtering out. And because we're not all 100% billable all the time. And so that's where kind of this starts coming into play is, if we showed up and worked on only client work from the time you got here to the time you left, then this number would be higher. But because it's not, that's just not realistic, and it wouldn't be a healthy way to build a company with any culture. I mean, that's basically a Indian sweatshop. Then that number would be higher, and we wouldn't have to worry about the other stuff. So that's where that 45% really comes in as the industry average. Other questions? Does this make sense, or did I just gloss it over?
That's awesome.
So when we look at, on Friday, when we look at financials, look through them from this filter. That know that where the expenses come in, where they come into play, where taxes come in, and how effectively we're using every payroll dollar. And so coming full circle back to the taxes thing is we've got revenue dollar here and we've got net income dollars here. So by the time something comes all the way through, when we're talking about 15 to 20% down here, so if that's saying if we have $100 in revenue, really we've got $15 to $20 down here. And what are new things purchased with? What are new people purchased with? Not this $100.
What you have left.
It's with what's left. And so, when they talk about tax percentages, tax, numbers coming down, so if this number, so say we got from here to here, and I don't know what the exact ratio would be, but say this is $30. Yeah, that actually would work. So if here we're at $30, and then $10 comes out from a third, and we're down to 20, then that means we have $20 to hire someone new. That means we have $20 to invest in whatever it is that we need to invest in. If this number was 15%, if it was cut in half, then that means we would have now $25 to invest in someone new. So we'd have an additional $5, so an additional 5% off the top to invest in some new people. So that's the kind of political rhetoric of why if tax percentages go down, job creation could go up. That's also with the caveat that businesses will use that $5 for people and not for